At some point in your business journey, you have to ask, is the structure I started with still the right one for where I'm going? When you first set up your business, you probably chose a structure that felt simple. And that was the right call at that time. But as your business grows, the questions change. How do I bring on a business partner? Should I reinvest profits or distribute them? How do I protect my assets or profits I have made? I'm Davie, and as a chartered accountant for over 18 years, I've helped thousands of clients with structuring their business from the startup phase to the growth phase and beyond. So in this deep dive, I'll run through the pros and cons of a sole trader, company, and a trust. When to consider more advanced structures, including holding trusts, bucket companies, and self-managed super funds, and case studies of real-life client examples. Let's get into it. All right, so welcome guys. This topic is about business structures, but also if you're planning to invest as well, you're planning to invest, buy property, buy shares, we can also go through that because it's actually about structuring sole traders versus companies versus trust. And it also applies to those questions as well. So it doesn't have to be specifically about business. It can be more specifically about other structures in terms of investment as well. So feel free to ask away and apply it to your business rather than, your situation rather than just like investment or business alone. Okay, but it's really important to look at the different structures and understand the different structures, because depending on what you're planning to do, you may decide to buy things or set up a business in your personal name, which is a sole trader, or possibly set up a PTY limited company, which is, you must have heard many times before, or something more special such as a trust or a investment trust. Yeah. All right. So option 1 and option 2 and option 3 are usually the main structures that people look at. Okay. It depends on what you're planning to do and the reasons why that structure might change. So the details that you need to consider when you're setting up a entity or setting up a business is you need to look at the tax rates, the simplicity, or like how simple do you want it to run, the income level or profit that you're making, the assets that you have personally, and the business or the investment that you have. Do you want to look at it as a short-term thing where it's like a 1, 2 years, 3 years investment or business, or are you looking at it as a long-term thing where it's 10 years, 20 years in advance? Because, for example, if it's like 20, 30 years in advance where you're not going to plan to change it, it might not be option 1 and 2 or 3. It might be like a super fund, SMSF instead. Because if you're looking at things like 20, 30 years in advance, then most likely it's actually for your retirement. So it might not be even a sole trader, trading company, or a trust that would work for your structure. Also, when you're setting up this business or investment, you also want to look at succession planning. So succession planning is a fancy word, but it's all about what happens after you pass away, or you stop running the business or you retire. How do I pass over the business or the assets over to my offsprings or to the next person that takes over? And that's also where exit strategy is important. If it's not someone that's within the family, we also need to structure and consider exiting as well. So when I first started my business, I always thought about, the exit strategy. The reason being is because if you go and run the business in one way and you don't give the option for exiting, it could cost you a lot of money at the end of the life of the business, like when you're planning to sell, because it affects the taxes as well. Property investment is also something like if you're buying a property, then you need to reconsider if you should buy it in your personal name, trading company, and investment trust. Also, one thing you need to look at is selling the business. They call it exit strategy and small business CGT concessions. I have done a deep dive on this, but it's basically, can you make yourself eligible for those concessions, the really good tax incentives that ATO gives you when you sell your business? And setting up the structure right from the start can give you that opportunity to be able to get those benefits. So that's why I always ask that question. Is it useful for you? Is it useful to consider exiting in the next 5 years? If so, then we should structure it properly to make sure that you can meet those eligibility requirements. Last thing is also when you're planning to retire. when you're planning to, are you planning to pay money to super? Depending on what structure you have, some structures force you to pay super. Some structures don't force you. Like sole trader, for example, you don't need to pay super. A trading trust, you also don't want to pay super. I don't know why. Oh no, I do know why. But some team members and some clients don't like super. Maybe it's because the client or the team member is young and they don't really understand super, but they also possibly don't think that they can access the money until 40 years later. So they don't really want to worry about super. And that actually does affect how you set up the entity as well. Cool. All right. So that's overall the different things you need to consider. But in terms of like what the difference between a sole trader, a trading company, and a trust is, a sole trader is basically a individual that owns or runs the business or owns or runs the investment asset. And legally and tax-wise, that sole trader is liable for everything. So they own the business, but they also own the asset, but they also liable for the business's liabilities as well as the debt, the taxes, and the risk, and also it owns all the personal assets together. So a lot of people talk about issues where there's no asset protection for a sole trader. And so a sole trader doesn't have asset protection is because every asset that they own personally, like it could be a Ferrari or a car, could be boats, they are owned in their personal name. And also the business assets are owned in their personal name. So if something happens to the business, they can basically, the person that's suing them can go after all the personal assets, not just the business assets. That's why a sole trader could be a bit dangerous. A company, on the other hand, it's a separate legal entity. Basically, instead of having an individual, we create a robot. We create a robot, and we've now given the robot some statuses. That robot would now have a flat tax rate of 25%. So 25%, sometimes 30, depending if it's investment. So if it's for passive income and investment, it's usually about 30% tax rate. But in this case, for a trading company, we kind of consider a robot, we give it a flat tax rate of 25 to 30%. We also say that it's got its own separate ownership of assets. So it can own assets for the business, and we usually put the business assets in this trading company. As a result of owning those assets, it can be sued and it can sue as well. So it can sue others. It could also be sued by, the creditors or, employees or suppliers. So as a result, your assets are protected kind of thing because your personal assets sit in your personal name and then you've got your business assets in the trading company. So that's where they say there's a limited a level of asset protection by having your assets personally protected away from the trading company. And also the risk falls on this entity rather than your personal name. Yeah. So a trust is kind of complex, but the way it works and the way I explain it is back in the day, this is how I learned it back in uni, is that there used to be the kings and queens back in England that would go, especially the kings that would go on crusades. And when they went on crusades, they would leave all their land and their assets to be managed by someone. And that someone ended up being something called a trustee. So they created these used to be people, they're individuals, and they controlled all the assets that was owned by the kings and queens. And so what they did is they created something called a trust. And over time, the trust then developed into like a tax structure. So now people create trusts just to own assets, but on behalf of the individuals, and they call those individuals beneficiaries. But they made it even more complicated. Beneficiaries doesn't have to be individuals, doesn't have to be just mom and dad. It could be, children. It could be charities. It could be related companies as well. So that's where that's what's happened with the trust, where the beneficiaries now are these individuals, but anyone also related or any entity related to this individual, the main primary beneficiary. Then what they did is they split the control. The control now is not managed by the individual or the beneficiary, it's managed by the trustee. And they also said the trustee could be an individual, but it also could be a company as well. So that's where they created the term trustee companies. So trustee companies are basically a separate entity that the whole job of that trustee company is to control the trust and own the assets in the name on behalf of the trust. And obviously the trust just has assets and profits, and the profits then get passed over to the individuals or the beneficiaries every single year. And that's what a family trust or investment trust is, discretionary trust. And that's how trusts were created. Obviously, there's different types of trusts. We won't go into particular details of that. But basically, a trust is a relationship with a trustee who controls the assets of the trust on behalf of the beneficiaries. And the beneficiaries are determined in something called a trust deed, which is a fancy word. All it is an agreement when the trust was set up that basically has a rule book of the trust and what happens to the trustee, how do you kick him out, who is the trustee, who are the beneficiaries, how do we pass profits out, all that stuff like that. So anyone have any questions so far?
Does holding the assets in the trust protect protect the beneficiaries of the trust if the company was sued?
Yes. Okay, perfect. All right. So yes, but only if the trustee is a separate legal entity, they call it. So it's not an individual. But the trust could also be, let's just call it Davie Mac. Could it be Davie? And the individual who are the benefits could also be Davie Mac. So if I own this business, then I'm technically, if there's assets in this trust, the trust itself can't actually be the person that owns will be the entity that owns the asset. In the legal terms, the trustee owns it on behalf of the trust. So if I put my name as the trustee and then I go and buy a property for the trust and I stand in contract and it says Davie Mac as the trustee, but also the owner of the assets, then if someone goes and tries to sue me personally for something, maybe I was at the pub, got into a fight, injured some person. So now that some person is suing me for, hospital cover and health cover and injuries and damages and all that stuff like that. It goes after me for $1 million. They can then go do a search on ASIC to check what assets I have. And I unfortunately own the assets on behalf of the trust. So my assets for the trust will also show up and then they will go after those assets as well. So the answer is yes and no. Only yes if the company is a trustee, because if the company is the trustee is a company, sorry, then that means that the company will own the assets and your personal assets are separated. Yeah. So that's why they say some accountants for some weird reason say or set up a trust instead, because it's very beneficial for asset protection. But I think the company also has that level of asset protection as well. Yeah, because it's basically borrowing the benefits of a company by having a trust. So a trust in a trading company has the same benefits in terms of asset protection. Yeah, but the trust has something that's better than a trading company that a lot of people forget, which is if you had two owners of the company, which is individual one and individual two, and they both own 50%, the company has a fixed ownership between these two owners. When you pay profits out, they have to go 50-50 to that person, to these two people. You can't give them one person 80, you can't give the other person 20, because the fact is this person owns 50-50, these two. Whereas a trust doesn't have that type of structure. It's like every year the trustee determines who we should give the profits to. So it gives you flexibility to be able to distribute the profits. So when a accountant tells you, oh, you should set up a trust because there's better asset protection, I actually think that's false. I think the benefit of a trust is the flexibility of being able to distribute your profits and give it to any beneficiary depending on the year or depending on what the trustee decides. The trading company has that issue where they can't do that. Yeah. But there are other ways to pay profits out. You can pay a wage or a contractor fee, but it's not really that well done. I think one of my clients mentioned that, you probably, the ATO might pick that up and say that you're creating a tax scheme if you're paying this person more a contractor fee just for tax purposes to minimize tax. Yeah. So it's better to have a trust involved. That's why there's option 4 where you have a holding trust. You have best of both worlds where you set up a hybrid structure. I call it a hybrid structure, but basically it's like a combination of a company and a holding trust, and you get best of both worlds. Okay, why would you not do that? It's because it's expensive. Like, you don't need to go and buy a Ferrari when you first start driving, because you might crash the car and damage it. Same thing happens here. There's no point setting up a company when you first start a business with a holding trust, with a trustee company, an individual, because it's quite expensive to set up. This structure here might cost you, about about $6,000 to set up. Whereas this company here costs you about $1,000, and this trust costs you $2,000. So why pay 3 times the amount, or even sometimes 6 times the amount, just for a better structure when you're just starting off and you don't even know if the business is worth anything, and you're not even really investing that much. You might be just investing $5,000 into business, and then you go and set up a business entity and structures for $6,000, which doubles the amount of cost that you're investing. Yeah. So my goal for businesses is for them to determine what their reasoning of starting this business or starting this investment structure, and then we will give you the best outcome or best structure for you based on what to consider.
Yeah, I had a question with the third option there, where you have the trustee company. Can you also have that structure where the trustee is just an individual to start with, and then maybe appoint a trustee company down the track? Is that?
Yeah, it's possible.
I've kind of got basically that kind of structure, but just a individual trustee currently.
Yeah, you 100% can. It does create some issues sometimes if you own property, because you got to transfer the property from this trust that's owned under your personal name on behalf of the trust over to the company when you create a trustee company. But I've done that for clients before. So I've had clients that come past, they join me, and then the previous accountant set it up like this, basically. And I just said, oh, your structure's good, but it's not the best, because look, if you're a risky person, and you might get into issues one day, they can pretty much go after you personally and your assets in the trust. And lawyers would tell you otherwise. Like, lawyers would say, well, you're acting on behalf of the trust, and that's the trust assets. But the fact of the matter is that when someone's trying to sue you, they just do a search and they will see all your assets, and they don't care if it's part of this trust. Because it's under your name, they're still going to go after it, and they're going to pull it into the court case no matter what, because they want to get the most out of you. So whether you created this trust or not, they don't really care about that. They would just bring it into the court case and try to force you to explain it and prove to the judge, which you could win. It gives them options, and exposes you to risk of being able to lose the assets in the trust. Yeah, so that's why it's not really recommended. But that's only an issue when worst case scenario happens, when someone's going after you. Most of the time when you're running a business, usually it's good. Like, no one's going after you and trying to sue you. But this is like worst case scenario. That's what, when you're speaking to an accountant and a lawyer, they're trying to protect you for that.
Davie, I got a question. The shareholders in the trustee company in this situation, are they the individual?
The shareholders of the trustee company? Yes, yeah. That's...
So the directors in the company are directors on behalf of the trust, correct?
Directors of the trustee company, which is on, which then control the trust. So
mum and dad are in the trust with the kids, right?
Mm-hmm.
Any assets you got, including the business, are in the trust, and then the company that's operating the trust on behalf of the trust, the trading company, can be individuals as shareholders and directors, right?
Yeah. So just to answer that again, yes, the shareholders are the individuals, and it's usually mum and dad, or the husband and wife. The only one that really cares about the shareholders of the trustee company is the banks. The banks only really want the people involved to be the shareholders. Most people, or most when you're like paying for signing a contract, or signing a some sort of like contract with your suppliers or builders or whatever, they don't really care about who the shareholders are. They care about the directors.
Right. So the directors are signing on behalf of the trust.
Yeah, signing on behalf of the trust. So they care about the directors, but the shareholders, they don't care too much. The only ones that really care are the banks. And usually, if you put mum and dad, or just the dad, or the husband, it's usually the best situation. So why do I choose? Okay, maybe I shouldn't say dad, but what I usually say the more risky spouse, the one that makes all the decisions and runs the business, should be the one that stands as a director and shareholder of this company. I don't try to include the partner, which is sometimes the wife or sometimes it's the husband. The reason why I do that is because I want one spouse to be the risky spouse, that if something happens, you're on your own. And then the other one is the one that maybe owns the house, the family home, and owns all the assets personally. And that's kind of like, yeah, what was that?
The only thing you need to do is to connect the dots to do that, is to appoint the individual company as a trustee for the trust, right?
Individual company as a trustee of the trust. Yes. Yeah. So
That's connect the dots that way. Yeah.
Yeah, that's done by the trustee. So the trustee, when you set up the trust, you'll have a trustee. The trustee will determine who the trustee is. And then if something were to happen to that person, say it's the husband, just using the husband as an example, and the husband, gets sick, can't actually act for the business or the assets anymore, we can make that person resign and then appoint another director. So if someone's going after the husband because a personal matter, then we'll just make that director resign and then we'll appoint a new director just to save the business and the assets.
So another question, does the shareholding in the company affect the distribution of funds from the trust?
Shareholder of the company? No, it doesn't.
Shareholding, so if it's not a 50-50 in the company, for instance, does that affect the distribution of the trust?
You're still referring to option 3, right? Nothing to do with option 2, yeah? So option 3, it's based on the trustee, and the trustee usually says the trustee determines who gets the distribution, and it's, whoever the beneficiaries are.
The shareholding in the company itself doesn't affect that distribution?
Most likely, no. Not the trustees I've seen.
So the recommendation is all profits are moved from the trading company to the trustee and they're distributed there in the trust. Yeah.
The profits stay here. They don't ever get given to the trustee. The trustee is just a controller.
Okay.
Yeah. So profits get stayed here and will retain here, and then you pass the profits every single year to the beneficiaries. Okay, there's one thing I want to mention to you guys before you ask that question, is that the trust itself shouldn't pay taxes. If you leave profits in the trust, you could be up for 47% penalty tax for retaining profits in the trust. So that's the downfall of having a trust, but also the benefits of having a trust. Because remember how I mentioned to you, there was a flexibility of being able to distribute the profits every single year to whoever you want. So therefore the profits can't stay in a trust. Whereas a trading company, the profits can stay in the company. Did you have another question?
Does it scale if you have multiple companies?
Okay, so if you're going more of the complex, because remember this deep dive is to do with sole trader versus company and trust. But what I did on the side, I also included, which was, let me just zoom into here a bit more, which is we have the same structure of option 3, and then we have a combination of the trading company still there. So what we do then is, if you're running a business and you want to open new locations, you also want to grow the business a lot and you start taking on more risk. I actually think I explained this in the previous deep dive, but your business will start restructuring. And then as a result, sometimes it's actually better to have this structure at the start. So you can just set up multiple trading companies under this trust. So all the profits get passed over to a trust. And then the trust can redistribute the money to the beneficiaries, and there could be multiple beneficiaries here. Okay. And then what you could also do later on down the track is they call it a bucket company, and create a bucket company here. All right. I won't go into too much specifics. This confuses a lot of people. And I don't recommend it to everyone because it's even more expensive to set something like this up and then have ongoing accounting costs for it. But you'll have, say, gym number 1, gym number 2, and then supplement business on the side. So you got all these profits here. They're all making money. But then you realize that one of them, you want to start taking profits out and buying assets for the business. That's where for the whole family. And then you start paying the profits out to the individuals or the bucket company, depending on what's better for that investment, as well as the tax rates. Like, do you want to pay too much profits out the individuals and pay 47% tax, or do you want to keep the profits in a bucket company that gets paid taxes at 25 to 30%? Cool. Does that answer the question?
Yeah, sort of. Mine's much more complex than that, but I can discuss it with Sean.
Yeah, Sean is one of the team members, just so others don't know. Option three is you usually start with option three with a trading company under the investment trust. And then when you want to scale, you start setting up entities on the side. But you don't have to set these up straight away. These can happen 2 years, 3 years down
Yeah,
the
and
track.
I've already got 4 companies and I'm looking to incorporate a trust. And my question was going to be around whether I set up a standard family trust style or whether it's a unit trust hybrid.
Yeah. Unit trust is only useful if you've got different business partners. Okay, so there's another downfall for option three. You can't have business partners in this trust because this is for the family, right? So this is mom and dad, children, charities, and related companies. So therefore, that's why there's not much flexibility with a trust. Brooke, did you have a question?
I did have a question. Thanks, Dave. So let's say we go with the investment trust.
Mm-hmm.
So that doesn't attract tax, then we're going to distribute the profits annually to mum, dad, children, charities, related companies. What percentage of tax do each of them have to pay when they're distributed the funds? So, for example, I've got kids. If I want to give them a portion every year, what tax bracket are they going to be in?
That's a good question. So it depends on the personal tax rates. So firstly, if the kids are over 18, they're governed by this tax rate here. So if they all make about $135,000 or under, if you're distributing that, they're most likely going to be paying 30% or less, right? But remember the way the tax rates work in Australia, it's bracketed and progressive over time. But just because you're on 100K and you're on this tax bracket doesn't mean that you're paying $30,000 in taxes for every dollar that you make. The first $18,200 is tax free. And then the next $20,000, $30,000 is, which sits on this bracket, is taxed at 16 cents. And then the rest of the money, which is like $55,000 up to that 100K, gets taxed at 30 cents in a dollar. So it's averaged out. So when I put in the 100K here in your tax calculator, you're basically paying 22.7% in taxes. So what we do when we look at this, and it's really hard to determine that, is we look at mum and dad's income personally. They might have rental income, they might have other income as well, dividends. Then we look at the children's income as well. And the children's one, if they're over 18, it's the same tax rates as this. However, if they minor tax rates, which is under 18, their tax rates are very different. So the ATO caught on to the fact that 10 years ago, 15 years ago, people were distributing profits to minors to minimize their tax. So what they did is the first $400 to $1,000, you're taxed at 66%. And then after that, you're taxed at 45%. So they started basically limiting the benefits of distributing profits to minors. So you can't really use minors as much anymore. That's why I think I did a video about this and people were just slamming, or some comments were saying there's no way you can actually distribute to kids or who are anyone. There are no beneficiaries anymore. And the reason being is because anyone that lives in Australia, the cost of living is so high, they have to work. And once they make over $45,000, which is pretty much a part-time job of full-time, you're definitely over 45K, your tax rate's 30%. So there's not really a benefit of distributing any money to beneficiaries anymore. You only really get a saving of 7% or 45% if you don't distribute it to yourself. So the argument now is what's the point of having a family trust? Can't distribute it. My reply to that is having a bucket company instead, where you can distribute all the profits into a bucket company. Yeah, so once you start making a considerable amount of money, you might rather keep the money not in the trust or not in the individuals because the tax will be too high, 47%. You might rather distribute the profits into a bucket company. Then people then argue that, well, I can't touch the money. And then my question is, well, what are you going to do with the money in the first place? Were you going to invest it? The answer is yes. And I was like, why don't I just invest the money in the bucket company rather than your personal name? Yeah.
Yeah, just on that bucket company, the holding trust, it would hold the shares in that bucket company. So it would be both a beneficiary of the trust and also the assets held in the trust. So is that so you can flick money between them easily through the trust? Is that
Yeah,
a
that's
correct
the reason.
understanding? Great.
Yeah. So some clients choose to have the trust own the bucket company, be a shareholder. Some clients sometimes choose the individuals, like the mum and dad, to own 50-50. Yeah. Because what happens is the whole point of this bucket company is to retain the profits, invest it, and keep like reinvesting the money. And then eventually this becomes your nest egg, and these companies will go. Like, let's use me as an example. I would start up Box, and I'll run Box, and I might start up another company that does something else. And I'll start making profits. And then eventually, say 10, 15 years down the track, I go, you know what? I've had it. These clients, they don't love me anymore. I'm going to quit and resign. And then what would I do is I'll sell this business. The business will be profitable. I'll pay the profits to a trust, and the trust will then pay it to the bucket company. But during the last 10, 15 years, I've been doing the same as well, retaining the profits in the bucket company, then investing it. Then I build up like an investment portfolio that has passive income. And guess what? The tax for the profits have already been paid. It's 30%. I've paid 30% of taxes in this bucket company. So now this bucket company holds all this profit as well as these investments. And because I decided to hang up my gloves and retire, these disappear. And I still have this structure where I can just now bring this technically down here, and then the profits just get passed to a trust, and then I distribute to me and my partner when I decide to retire. And because I've already paid 30% tax, I would just distribute myself $100,000 each every single year. That's enough for me to live off. And remember how I did the pay calculator before? And I said 100K, you pay $22,000 in taxes. Remember, I just told you that we've already paid 30%. So I've already paid the taxes. So I'll just live off that for the next 10, 20 years. And if I need any extra money, I'll just take that money from the super. So that's a very good retirement strategy for people. You want to work your butt off and you want to make money, but you also want to make sure that your money starts making money for you. And I think a lot of business owners, they struggle to do that. They forget about actually taking the money away and then putting it into a bucket company and reinvesting it. What they do is just take the money and put it in their personal name and start buying assets personally. But that creates a lot of risk. Sometimes they buy personal assets too. They don't even reinvest it. And that's where it's a big no-no, I think anyway, that you should actually think about starting to reinvest. But one quick disclaimer, I'm not a financial planner. That's just something I would do.
But just to confirm on that though, so if the bucket company's paid the 30% tax each year,
Yep.
then you go and pay yourself 100,000 for that year, you don't pay tax on that 100, or you do pay another 22.
You get a credit for that 30K, and then what happens is, going to here, all your income gets added up. So if you've retired, which I was in my example, I've stopped working, I don't have any other income. So that 100K that I take from the holding company or the bucket company is my income. And because there's a credit of $30,000, that $30,000 will credit this tax. So try guessing what happens. I actually get a small refund. Yeah, I get like a $7,200 refund. But if I'm still working and I'm also getting a wage from Box Advisory Services, then my income might go up to like say 300,000 because of that dividend that I take. And then that's where there is a 30K credit, but then it might not be enough because my tax rate is higher. Yeah. So that's where people say there's a top-up tax sometimes. So say my income is like, say this is me, this is $200,000, and then I pay another 100K to myself, then the total income that I get to myself is technically 300K. But for that 100K, I've already paid 30% in taxes. But remember, my tax rate, because it's over 200K plus that 100K, let's go back to these tax rates. I'm on a 47% tax bracket. So it's 2% of Medicare plus 45. I'm slowing this down because a lot of people can't follow in this. But then what would happen is I've paid 30% tax because the company's paid it, but then my tax rate's 47, so therefore I still need to pay a top-up tax of that, 17K for that 100K. Not this one here, it should have been paid by my employer, if that's box. Yeah. Okay, so that's how top-up tax works. But if my income was only this, then that changes everything because my tax rate isn't 47%. It's like, less, 30%. But because the first $18,000 I'm tax-free, and then the next 18 to 45 is taxed at 16 cents, my blended tax rate becomes 23%, I think it was. So as a result, I kind of get a small refund. Yeah, that's how it works. Only works if you're looking at it long term. So that's why I always tell clients, like a lot of accountants, they always say, Davie, you're lying to your clients because you're trying to in the end they end up paying the high tax. And I said, well, it depends. If they decide to retire and they don't have any more income, then the tax they paid is 30%, and they might even get a refund when they pay it to themselves because they're going to distribute 100K to this individual and another 100K to this individual, and then they can just live off that. And if they can't live off that, they still have super that they can pull money out of too. So because they're over 60. If they're not over 60, then they have to live off 100K each. They can pull more money out. They just pay a top-up tax. That's all.
On that distribution, that can be spread across multiple years, correct? Is that right?
Yeah. Well, no. Distribution of bucket company, or are you talking about the trust?
A bucket company. So if you
Yes.
put funds in a bucket company, you could distribute to your individuals as dividends over multiple years, so you could optimize the tax you might pay.
Yes.
Rather than
Yeah.
sort of taking it all in a big chunk and being a high tax rate.
Yeah, that's why like a lot of accountants don't know what they're talking about, where like a bucket company and having trading companies and a trust is actually very useful because paying all the profits out to here, you're paying 47% taxes. If you say you made $1 million and you just pay 47% tax, you've lost pretty much like 400K easily in taxes. But if you left it here, you lose 300K, you still have that extra 100K, and then you take that 100K and you reinvest it, and that 100K keeps making you more money. And you do that every single year. By the end of 10 years, you've compounded you've managed to minimize your tax as much as you can. And then you've compounded the minimizing of the taxes and reinvested that. Then as a result, there will be a lot more money in the bucket company rather than just every single year paying 47% tax and then reinvesting it. So
is it fair to say you can really cut down the CGT that you would pay if you bought property in that bucket company because you can do this sort of splitting it across multiple years?
You end up paying more CGT in the bucket company. However, you end up with more profit. Okay, so a lot of people will get confused when I say that. Basically, the reason being why you're paying more taxes by leaving the money in the bucket company is because you've actually essentially made more profits. So therefore, you pay more taxes, and your bucket company would make more. The reason why is because I use the example of that $1 million. If you made $1 million in this company and you passed it over to your personal name, you'll be left with, say, 500K. Round this up to 50%, you'll be left with 500K to reinvest. But if you pass it over to a bucket company, you'll be left with 700K to reinvest. So if you start with 700K rather than 500K and buy a property with it, and say that property goes up in value, 5 times in the matter of 20 years, you'll be left with this. And say if you did this 5 times, you'll be left with 3.5. Which one will pay more taxes? Obviously this one, because there's more profit in there. Yeah, so I don't know. I don't get the argument. Obviously accountants always say like you pay more taxes as a result anyway because you're going to take the money out. So you might as well just pay it.
As well, David, isn't it? If you weren't to sell those assets, then you could just leverage that and you'd be much better off.
Yes. So a lot of people then just refinance the money out and then just buy another asset and keep doing it. One thing you got to be careful with is, I forgot to mention, is the company doesn't get a 50% discount. So on capital gains. So there's no 50% discount, whereas a trust does. So sometimes a lot of accountants say buy the property or investment in a trust, so you can get a 50% discount. But back to what you just said about refinancing, you don't need to think about ever selling the asset because you can just refinance the money out and buy another asset with it, as long as your income can support it. But over time, your income can, because the longer you hold a property, the higher the rental yield goes up. and then eventually you can refinance and buy more properties with it. But yeah, I don't care too much about the no CGT in a bucket company, the no CGT discount. Because I'm not planning to sell, but it all depends on your intentions. So that's why I say exit strategy, buying property, like those things make you consider whether to buy a trust or a company.
Hey, David, just a segue on that. I might just jump in. In terms of setting up trust structures and that kind of thing for a business, which is fair enough, that's probably what we're talking about here today mostly. What about setting up trust structures purely for asset protection, whether it's your home or, cars or, whatever it might be?
Yeah.
Is that something you can also help with? And would you suggest that is a good move?
It depends on what you're trying to protect from and the risk. So what are you trying to protect first? And is it worth protecting? So if your assets, say, if you have a lot of assets and say you're talking about tens of millions of dollars on assets, then yes, some people rather put that into a trust because they don't want their kids fighting for it. So
I'm
they,
thinking more along the lines of, let's say you're a PAYG employee, but you've got a few properties. So simply just putting those into a trust, not because of you're running a business, but simply because you want to protect those should you be pursued or legally
Yeah.
or sued in down the line for whatever reason.
yeah. And my question to you is, why are you going to get sued? Because you're a PAYG employee, your boss will get sued before you.
Oh, I mean, it could be outside of work. It could be any particular reason, right?
Yeah, and that's it. It's a case by case basis. So, like I said, like if your ex-wife's gonna sue you, then yeah, definitely put in. Like that's you can't control what your ex partner is gonna do, and they have a lot of power if they've got kids. So that's why I'm saying like it really depends on what you're trying to protect and how much power those people are gonna sue you for. Like if yeah, and
I mean, it
what
could be
risk.
something as simple as someone steps on is at your home and injures themselves, and then they want to sue you, right? And then
Yep.
you'd want some protection against something like that, for example.
Yeah, so for home, I would then go, it's a bit too extreme to put your home into a trust. And the reason being is because one, you could have a partner. So putting it under a partner might be a better idea. And if you do put it in a trust, and the partner is like low risk, and you're more risky. So you just have one partner that is less risk and then one partner that takes on the risk. And then the second thing is that if you put the home into a trust, then there's an argument is that your main residence anymore, because a trust isn't technically a human being. So therefore you don't get the main residence exemption. So therefore you get taxed as a result.
Yeah. Okay. We can talk about this another time. Yeah.
Yeah. But one last thing is that having the property owned in your personal name does create some sort of protection as well, because the banks usually have a loan on it, and the banks would not let that anyone go after that asset that easy. So just so you know, there is a form of protection by having a bank have a loan on it as well, just so you're aware. So yeah, a lot of people just they freak out about having assets in their personal name, and yeah, most of the time when they just honestly, you just watch too many movies, or yeah, because most of the time no one will go after that asset because it's just too hard to go and fight the banks because they have so much money as well. So what is the benefit of having a shareholder in a trustee company? So there's no benefit of having a shareholder. It's just that a trustee company has to be a company. And as a result, you need shareholders to own that company so they can kick out the director. But the trustee itself, the only job of having a trustee is so they can control the investment and the assets. And it could be a business or it could be an asset. And just to explain, you don't need to have a company to as a trustee. You can have a individual, but I don't normally recommend it because if the individual does something personally, it could actually bring down the trust as well. So that's why we always prefer setting up a company. However, it does cost a bit more money to do that. In terms of profit sharing, does it apply to startup IT consulting where there are just two shareholders, or do I leave retained profits? If I shared a profit, it might be 47% tax. Each of us, yeah, I'll take it out as a Div 7A. Okay, cool. If I go down that road, does that mean that I need to create an investment property trust? Do I need to create a bucket company and then move my profits there? Okay, this one's special. Let's draw it out. Okay, so so I'm gonna go through some examples because I think that's where everyone's talking, like wants to ask more questions related to their business. In your case, because you have a tech company or a startup company, if you really want to have the ability to distribute profits, and you also understand that you have a business partner involved, you'll create a hybrid structure where you have a trust that owns the trading company, and this will be 50%, and then the other trust, which is your business partner, will own 50% of that trading company. So then you get the best of both worlds. Yeah. So, however,
I add that question. The business partner is my wife, actually.
Oh, the business partner is your wife, then yeah, you can just have the trust instead because she's included in the family trust anyway. Yeah. So like this trust here, you don't need to have two separate trusts. Okay. The only reason why you want to have two separate trusts is because if your business partner is like a third party that isn't included as a family, then you want to separate that because they won't be tied into the trust deed and they won't be a beneficiary. However, having your business partner as your wife, then you will just have one family trust to be able to utilize bucket companies. Yeah, you're going to always have issues about taking money out and paying 47% tax if you make over 180K each. So the benefit of having a trust is using that bucket company example here. Yeah, cool. Sounds great. And can we pass assets and income of the bucket company to anyone or its shareholders? Yeah, you only can give it to its shareholders. So I sometimes have the trust as the shareholder or sometimes the individuals. If the individuals are going to be the ones benefiting at the end of the day, then you might just have the bucket company owned by the individuals. And then you can get rid of, when you decide to retire, you can actually get rid of everything. All these things can be sold and removed. And then you just have the bucket company that's got all the retained profits and then slowly just take 100K out every single year. Yeah. That's sometimes the avenue for some business owners where they've come to me and they're like 50 years old and they want to retire in 10 years. They don't really want to have a trust anymore. They just want the individuals to be owned, the profits to be owned under their names. Yeah. Cool. So can bucket company be offshore? Bucket company can be offshore, but you also have to prove that you're not creating a tax scheme when you set up an entity overseas. So be very careful of that. It has to actually make sense why you have an entity overseas. If you live in Australia and your business is in Australia and you have like some offshore entity overseas and the money's going over there, very hard to prove that you're not doing it for tax purposes. Yeah. However, if you live overseas and you have business overseas as well, international businesses like e-commerce business, then it kind of makes sense having an entity overseas. Okay, so just be careful because like the ATO has these rules, they call it Part 4A, which is it's anti-avoidance of taxes. So if you're creating a scheme just to transfer all your money overseas, and you live in Australia, very hard to prove that you're not doing that on purpose, just for the sake
They
of
will
tax.
flag that, and essentially you'll potentially have to pay tax on that.
Not just that, you could possibly even get prosecuted. Yeah, you can potentially get prosecuted as a result of that. Yeah, so that's why there has to be a reason of doing that. So for example, like we have dealings overseas, so therefore we've got an entity that takes a bit of the profit and also pays over to the offshore entities because there's offshore people that work with us as well. So there was a reasoning of doing that. Yeah, so that makes sense, but you can't just transfer all your profits over. And don't forget, like if you actually live in Australia, you want your profits to be here because you want to spend it. So it's very hard to like transfer all your money over there and then spend it over there for Australia. And you can't get any loans. If you want to buy an asset, you're going to struggle as well because all the money is overseas. Okay, is there a period of time that we had to wait until switching structures to take advantage of both? Oh yeah, so there really isn't a period of time. That period of time could be like 1 year, it could be now, it could be tomorrow. It just depends on what your strategy is and your goals. Usually, I would say that if you want to switch from trading company owned by individual because you want to save money and then moving to structure like this, you have to do it before this business is worth anything or a minimal amount. So let's just say that you started an e-commerce business and the first 6 months, you haven't really made that much money. because and then when you start paying yourself a wage, there is no profits in the company. But say a few months later, you've just killed it in your sales and it's just like went up to like 100K turnover or sales per month, then you know that it's going to start making money. That's when you should start restructuring over to selling this shareholder of this company over to a trust, because the business isn't really worth anything at that point of time yet because it's just kicked off. So we can argue to the ATO that you're selling the shares for the same amount that you bought them for, which is like $10 or $5 or whatever it is. So it's actually better to transfer the business when you know that you're about to make a lot of money, and sell the business. Or when you're going to sign a contract, or when you're going to get the business valued, or you're going to go take it to get an investor involved, you might want to just restructure just before that happens. Yeah. Because the ATO has this rule where it says that if you're selling the business or the asset to a private, to a family member or to a relative, they will take the market value of the asset. If the trading company is making profits and it's very profitable, then you've kind of missed the boat. You have to technically value the business at the market value rather than selling at a cost price. So always try to do it before that happens. And the thing you do is just pick up the phone, call that accountant to do that. As a sole trader, how can I protect my assets? I have been a sole trader for 12 years. To switch to a company means any assets are protected, but then I need a business partner. No, you don't need a business partner. You can just switch and have this individual own 100% of it. You can just have a shareholder be 100% you. So you don't need to have a business partner. It will just cost you about $1,050 plus GST to set this up. Or you can, and then you can restructure into a trading company. Especially when you can argue that you've been a business owner, the sole trader is not really worth, the business is not really worth anything. You can technically transfer over to here quite easy. I think there's rules where you can restructure from a sole trader to a company. It's called the restructure rollover rule, restructure rollover relief with the ATO. Small business restructure rollover. And you need to just prove you're running a small business, and when you do the transfer of the shares or the business, the ultimate economic owner, whatever they call it, what is it called? Owner, right? This is not the ultimate economic ownership remains the same. So as long as you own 100% of these shares of this business, you can move from a sole trader to a trading company with no tax consequences. But this happens for sole trader to a company. Company to trust or this type of structure may be different.
Just a quick one on that option 4, where you had the holding trust and the trustee company. Can you reuse that trustee company if you're running an SMSF? So it can be the trustee for multiple trusts. Is that a way you could optimize if you were running a SMSF?
You can, but just so you know, like SMSF has a lot of rules. Like the members of the SMSF have to be the directors and shareholders of the trustee company. So you might then say that you have a SMSF for mom and dad and yourself and your partner, then you will have like 4 people. And then it starts getting, then there's 4 people that have to sign on behalf of all these structures. Like it just gets complicated.
It wouldn't work with the family trust as well. You kind of want to set up a separate vehicle for that.
Yeah. Okay. Usually people separate it. It's better that way. But
I just thought I'd ask because I was, is there a way to optimize the structure, I guess?
Yeah, but you're only saving $1,000 just to keep it not too expensive. But really, it just makes it complex on who's signing and who isn't. And it's not really recommended because the banks get very confused. Problem with banks is you're dealing with people that just, they probably not that skilled and understanding of a structure. So when they have a trustee company that is a trustee for SMSF and a trust, they get just so confused. They don't even know what they're doing. And then as a result, they might deny a loan because of that sake, that they don't get it.
No, thank you for that. That's really good.
Yeah. Cool. Here's an example. So a lot of clients come to me and said, hey, I'm a mortgage broker, new business owner. I want to set up my business next month. I used to make 150K and I'm assuming that next year I'm going to be making that, but I want to set up a business now because I want to go out on my own. I also have a partner that's $60,000 part-time. separate from me, that she or he works in that business, works in another business, and potentially could go into business with someone else. So because that person's a mortgage broker, the client that's coming to us, they potentially might have another workmate that they might team up with later on down the track. So in this structure here, because they're making about 150K and they're trying to grow their business and the goal is to grow, I would set up the business as most likely a trading company, option 2. Okay, and the reasoning behind that is because they're trying to grow, I want to cap their tax rate at 25% or less. So pay wages up to 25%, a tax rate of 25%, and then the leftover profits sit it in the company and reinvest it. And because you might have potentially another business partner, this gives you the structure to be able to do that. You can go as a sole trader, but then you have to restructure it later on down the track into a trading company when the business partner comes on. So you might also, the easier way is just to sell 50% of your shares over to a business. You could go even more detailed and have the option 4 structure, but it's a waste of money to spend that much when you're not really making that much and the tax savings won't be there. So that's for example 1. Example 2, family business. So your family's been running a business. It's a restaurant. There's mum, dad, and adult children running the business together. One happy family. Profits are about 300 to 400K. There's no wages right now. That's 300, 400K, including wages, like drawings that they take out of the business. And potentially they want to open up more restaurants and locations. No other business partners, just the family-owned business. Businesses will go to the adult children when the parents retire. I sometimes see, and I actually recommend a trust structure for this. Okay, reason being is because you can split the profits to and distribute the profits to mum, dad, and adult children, keep them all under 100K or close to 100K, and as a result, pay little amount of taxes. Don't have to deal with super, don't have to deal with insurance, workers' compensation, and also because you've got so many family members in the business, you can actually utilize the distribution of profits to the individuals to minimize tax as much as you can. If you start making more money, then you can set up bucket companies to distribute the profits to. So that helps that. And there's no potential goal of selling the business. They want to just keep it. So there's succession planning's there already because under the family trust, you don't need to transfer it over to the adult child later. So that's why a trust will be better for a restaurant. Okay, example 3, construction business. Okay, construction business, straight off the bat, I would always say set up a company. And the reasoning behind that is because it's too risky. So this trade is a plumber. Yeah, sure, you might be engaged to do a job for $20,000 or $10,000. It's not that much, maybe even $500. But if you're doing the job and then you accidentally damage the building, it could cost you, hundreds of thousands of dollars to fix it. So that's why it's too risky. And so therefore, as a result, we always set up a company for asset protection. Yep. So that's the main reason. And also the fact that you have to buy equipment, you have to potentially get loans, you have to buy cars to grow the business. And also there's a potential goal of getting a business partner. So company's the way to go for tradies most of the time. Personal trainer or content creator with PAYG income. So this is example 4. I normally see this a lot where, especially the younger crowd, where they earn about $100,000. They possibly have an investment property or may or not. And they have no partners, but then they're earning side income on the side. So they call it side hustle income. All right. And it really depends on what income are you making. So remember when I said to you at the very start of this conversation was you got to understand the tax rates of how much you're making. And if you're making about 120K or over 135K to be exact, you're paying 37%. So sometimes say your wages are 135K, I would actually recommend maybe setting up a company to house that side hustle business because the company pays taxes of 25%. But if you kept all the profits in your personal name, you'll be paying 37 plus 2%, so 39% in taxes. And it may not be that great. So there are 2 options for you. If you're under 130K, under 135K in income, set up as a sole trader. Over 135K, set up as a company for the side hustle on the side. Okay. However, if you're a content creator and you're doing like a risky space and you might be getting sued, for example, cryptocurrency content creator, you might want to just set up a company straight away because it's risky for you. But yeah, this is generally what I say to the clients. If you're under 135K, your income is quite low and you're paying 30% tax. So there's no point setting up a company because if we're going to pay the same amount of taxes in the company versus as a sole trader, there's no benefit. The only benefit is asset protection. So it's up to you if you want to do it. But if you're planning to grow and you think you're going to make over 135K, then set up a company to house the side hustle. And it doesn't have to be content creation. It could be like personal training or anything like that. Okay, last thing is investing in property. Like this is a clear example of a client that comes to me all the time. They say they're making $200,000. They've got a partner that makes 120. So overall family income's over 300K. And then also they've got an investment property in their personal name already. They also got a home. Property will be negative geared. The next property they want to buy is negative geared. But the next 2 to 3 years, it should cross over to be positive because the rent will go up. And they want to buy, hold, refinance down the track, looking to buy more investment properties and borrowing. They have currently borrowing capacity in their personal name because they've got an investment property and a home loan in their personal name for their home already. So they want to set up a company to borrow more money. They want to buy more property. In this situation, it really depends. So this one is kind of like a left field. The reason why they're coming to us is not just to minimize taxes or anything like that. It's because they want to increase their borrowing capacity. So they've got borrowing problems right now. They can't buy any more property because their income can't support it. So yes, you could possibly set up a company or a trust to open up more borrowing capacity. But there's also another option of SMSF. So some clients then look at a super fund down here because they've got a member balance between the partner and themselves. And that could be about 200, 300K. And they could also use that to borrow more money as well. So it may not even be, it could be a company or a trust in that structure, or it could be even an SMSF for them. But they got to, analyze the benefits and the pros and cons, because borrowing under a company and trust or SMSF, the interest rate is usually higher. And usually it's nothing to do with trying to save taxes. It's most of the time trying a company or trust or SMSF is usually the best move. Buying in their personal name is usually out of the option because of the sake of they can't borrow anymore. But if they can borrow anymore, buying in their personal name, their income is quite high. So if it becomes positively geared after a couple of years, then they're going to be paying a high tax bracket, a tax rate in their personal name if they continue to do what they're doing. Yeah, so usually SMSF is the way to go, or a company or a trust, and then possibly in their personal name is the last situation for them, last option. Cool. All right, that's it. I think that's it. So if you guys need anything else, feel free to reach out to us. But I appreciate everyone joining and asking the questions. This is great. I'll see you guys later. Love you guys. Bye.